In June, South Korea claimed the title of the best-performing stock market in the entire world. Investors rushed in, locking in their capital, because South Korea manufactures the memory chips required to keep the global AI revolution running. The logic behind the rush was solid. Giants like Samsung and SK Hynix saw demand for these specific components explode. Samsung's chip division is currently on track to generate more profit by 2026 than it did in the previous 40 years combined. But that parabolic climb snapped. The Seoul market recorded one of the fastest crashes in modern history, plummeting 34%. Understanding this collapse requires looking past the physical hardware and into the specific financial products used to buy those stocks. Both retail traders and institutions poured money into this sector using complex financial instruments. These tools altered the mechanics of market stability, adding a layer of automated risk to every trade. The Seoul collapse highlights a failure in the market's internal plumbing, where automated logic overrides investor sentiment. The core accelerant here is a product called a leveraged ETF. Driven by the fear of missing out, investors bought into these funds because they multiply the returns of an underlying asset. If the stock goes up slightly, the ETF value spikes. This graph illustrates how these funds distort market behavior. You have organic demand slowly pushing prices up on the left. On the right, the leveraged capital forces an unstable spike. The trigger for the collapse was a single report: news that China had begun mass production of its own internal chip-making tools. The idea of new competition caused a slight dip in the stock prices of South Korean manufacturers. It was a standard market reaction to a change in the competitive landscape. In a traditional environment, a small pullback passes without issue, but in a market saturated with leveraged ETFs, that minor dip acted as a detonator. Here is the rigid math at the center of the crash. When the price of the underlying asset drops, the leveraged ETF must sell off portions of its portfolio to rebalance its risk. This selling is an automated execution written into the fund's code. There is no human manager deciding whether to hold through the dip. Because so many of these funds exist, they all dump shares simultaneously. This massive forced offloading of stock drives the market price down further. That new, lower price hits the mathematical trigger again. The funds execute another round of selling, feeding a devastating doom loop. The 34% crash demonstrates how rigid mathematical code takes a minor catalyst, like the news from China, and accelerates it into an inescapable spiral. This brings us to Wall Street, which is currently operating on a very similar blueprint. Leveraged ETFs are a massive, growing structural component of the U.S. market. At the same time, the American AI boom has become incredibly top-heavy. Look at the concentration in the S&P 500. Roughly 69% of the entire index's gains came from just 10 mega-cap tech stocks. The bulk of the market's growth rests on a tiny sliver of companies. That concentration has pushed U.S. tech valuations to levels not seen since the peak of 1999. Wall Street has priced these stocks for perfect growth, leaving no room for error. The current market structure leaves the U.S. vulnerable to the same mechanical selling traps we just witnessed in Asia. The foundation of this boom is shifting. Big tech companies are increasingly funding their AI infrastructure through massive borrowing rather than their own cash flows. Debt introduces a new set of constraints. As credit spreads widen and interest rates stay elevated, the cost of servicing these loans makes ambitious AI projects less profitable. An external threat has also emerged. 30-year U.S. bond yields have reached 5.2%.